Business development companies, or BDCs, have delivered mouth-watering gains recently. Here's Main Street Capital surpassing the S&P 500's total return over the past year, 34% to 24%. These returns have been enhanced by high interest rates, which begs the question, what happens when the Fed cuts rates? Will BDCs be in trouble? BDCs are private lenders that focus on lending to medium-sized businesses. That doesn't sound as exciting as manufacturing AI chips or making cool phones, but if you're an income investor, there's plenty to be excited about, specifically high yields and consistent income. Here are the payouts from the biggest BDC, Ares Capital, over the past 20 years. It's currently yielding just over 9%. There's a lot to like, but rate cuts have some BDC investors nervous because high interest rates have been boosting profits recently. If we look at Main Street Capital's distributions, we can see a spike in special distributions recently, or as Main Street calls them, supplemental. This is additional income paid to investors above and beyond the regular distributions. And here's the link between higher interest rates and higher payouts. An increase in interest rates of 100 basis points, or 1%, translates to an extra 17 cents per share for Main to distribute to its shareholders if they so choose. Why? Well, because Main borrows money at low rates that are mostly fixed. To be precise, 72% of their borrowings are fixed. Then they lend at short-term variable rates. As interest rates rose, the gap between what Main paid for their money and what it earned from its borrowers expanded. At some point, that will reverse, of course, and interest rates will fall, and quite possibly that may happen quite soon. So now you can see why some BDC investors are concerned that the party is over. Today, we'll look at why it's not quite that simple, and what happened to BDCs the last time rates were cut. Let's run through the major effects that rate cuts will have on BDCs. And by the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, and if you'd like a copy of my portfolio, it's called Armchair Insider. Link in the description, it's free. So, what are the effects of rate cuts on BDCs? First of all, yes, the net investment income will shrink. Just like the chart says, in the case of Main Street Capital, a 25 basis point cut would equate to 4 cents per share. That would probably show up as a reduction in the supplemental dividend. The green lines will get shorter. Secondly, as interest rates fall, it becomes easier for BDC customers to pay back loans, which means the risk of default is lower. Fewer defaults means fewer losses, which is good for business. The caveat to that is a major recession would increase defaults regardless of interest rates, but that doesn't seem likely, at least in the near term. Thirdly, lower rates means more demand for loans. As the number of potential borrowers increases, BDCs have more leverage. They can become more selective about who they lend to. Also, they can negotiate more favorable loan terms. And last but not least, BDCs are private lenders, but much of what I just described can be applied to banks. This last factor is different. Unlike banks, BDCs can take equity positions in businesses they lend to. In recent years, that hasn't been so profitable, unfortunately. High interest rates made it more difficult for companies to grow. If lower interest rates allow BDC borrowers to grow their businesses, then when they realize that growth through, say, an IPO or the sale of the business, a BDC can take a piece of that gain. Most realized gains take the form of IPOs or mergers and acquisitions. As we can see from this chart, IPO and M&A activity has been low since interest rates shot up. Everything I just said is theory. Let's look at what actually happened to some BDCs the last time rates were cut. Here's a one-year snapshot, December 31st, 2018 to December 30th, 2019. In other words, the year of 2019. During that year, the Fed funds rate fell from 2.4% to 1.55%, almost a full percentage point. The biggest BDC by market cap is Ares Capital, and it's also one of my largest holdings. During that period when interest rates fell, ARCC did just fine. Actually, better than fine. It delivered a total return of just over 30%, which is not bad for a private lender. To give some context, not surprisingly, the overall market reacted favorably to rate cuts as well. The S&P 500 delivered similar results, about 30%. Let's look at the income. ARCC has a long history of delivering consistent distributions, and 2019 was no exception. Despite the rate cuts, the regular distributions were unaffected, and in addition to that, ARCC also paid out some special distributions. What about other BDCs? Instead of looking at them one by one, we can just use the BDC Fund to see the overall trend. BIZD, that's B-I-Z or Z-D, is the largest BDC fund, and its portfolio currently consists of 27 BDCs. During that 1 year period when interest rates fell by almost 1%, BIZD also did better than fine. Compared to the single largest BDC, Ares Capital, the fund ended up with a similar result, a total return of 30%. As for the distributions, they fluctuate from quarter to quarter, but looking at a 10-year history, there's nothing odd about that rate cut period of 2019. This distribution chart came from Snowball, but I mostly use Snowball to keep track of my current income and my future income. I can visually rank my portfolio by current yield, see yield on cost, and know exactly when the next dollar will land in my account. There's a link in the description for a free trial and a discount. And in breaking news, if you're watching this between September 9th and September 18th, 2024, Snowball will be running their autumn sale during that 10-day period. It's not an expensive service, but when they run those sales, the discount is quite good. Of course, I can't predict when you'll be watching this, so the link in the description connects you to the current Snowball promotion or the Armchair income discount, whichever is greater. If you're new to BDCs, you may have caught on that they generate a lot of income. The Raymond James BDC report shows a median yield of 11.7%. That's a fairly high yield. However, some of the highest yield BDCs are too risky for me. You could research them individually and you could choose your favorites, or you can just buy a fund. BIZD is still the largest BDC fund, but I don't own it. I hold a newer fund called PBDC, and it currently yields just over 9.5%. Let's compare their total returns since PBDC was launched in 2022. We can see that they followed each other very closely. Then, as time went on, PBDC has gradually pulled ahead. The main difference between them is that BIZD is a passive index fund. It simply follows the MBIS US Business Development Companies Index, which is a mouthful. On the other hand, PBDC is an actively managed fund. The fund manager, Mike Petro, adjusts the BDC holdings in the fund based on things like value and expected performance. I know some investors think that the lowest management fees are the best management fees, but that's not always true. BIZD's management fees are 0.4% and PBDC's management fees are 0.75%. Despite the higher fees, PBDC investors have been earning a higher return than BIZD investors. If you want to learn more about PBDC, this analysis was published just a few days ago by Juan de la Hoz on Seeking Alpha. He goes into way more detail than I can in this video. I use the Seeking Alpha app every day, and I explained how I use it to find income investments in this video. I'll put a link in the description to the video I just pointed to, the PBDC analysis article by Juan, and also a link for a free trial and a discount. One last point about fees for BDC funds. This is very important because the fund websites and fact sheets are unclear on this. The SEC requires BDC funds to express their expenses in a very confusing way. If you look at the PBDC website, it says the expense ratio is 6.79%. If you think that's ridiculously high, check out BIZD's website, 13.33%. Yikes. Is the fund manager taking a huge fee and buying a yacht? No. If you review the prospectus, the actual management fee for PBDC is 0.75%, which is quite reasonable for a small, actively managed fund. The confusion is around something called acquired fund fees. The SEC requires funds like these to include expenses like the payroll and real estate costs of the individual companies held by the fund, which makes no sense. You can imagine If SBY had to include these types of expenses from companies in the S&P 500, it would display a crazy high number as well. It's all explained in this brief document that I'll link in the description. My point is, if you see a crazy high expense ratio for a BDC fund, don't accept it at face value. Do some digging to find the actual management fee. I don't think rate cuts are a reason to dump BDCs. The unusually high special dividends will revert back to lower levels, but that's not really a big deal. There are about 50 BDCs, and they're not all good investments, but I think the well-managed ones will be just fine. And if you want to learn more about BDCs in general, this video is called Should I Buy a BDC Fund? That wraps it up for this look at the effect of rate cuts on BDCs. More Armchair Income coming soon.
Armchair Income, that's my hustle and my groove.